Well, good news is bad news again. The September non-farm payroll report came out today, and gosh, I can't remember what the ADP report was on Wednesday. I didn't pay much attention to it, but the NFP is out, so the ADP is irrelevant now anyway. Even though the ADP is usually wrong, job creation was better than expected. There were 263,000 new jobs added to the U.S. economy, and 255,000 were expected, and the unemployment rate dropped to 3.5%, which we're being told is a 50-year low. Now, this is enough to give the Fed room to continue to continue to hike interest rates. They do not have any cover, certainly, to cut rates. The Fed already is pointing to this unemployment rate, and they're saying, look, everything we're doing is fine. We've done well so far, and we're going to continue to keep doing the same thing. We're going to continue hiking rates and trying to rein in inflation. Because at this point, the Fed so far has been willing to sacrifice the stock market to let asset prices drop, which they haven't dropped nearly enough. But the Fed is allowing stocks to go down so long as unemployment is not being too negatively affected. So far, it's not been negatively affected at all. Unemployment is at a 50-year low. And so as long as the Fed is hiking rates and they see unemployment at a 50-year low, there's a zero chance of them cutting rates. But rate cuts, of course, are what Wall Street wants right now. They want the party on Wall Street to go on forever. The S&P 500 was down 1,000 points already this year, and today it was down almost 3%, 100 and some points, around 105, I think. And so we're down to 36, 39. Still much higher than we were before the Wu flu back in 2020. We are still well over 3,000. So the stock market has a long way to fall, because the stock market was overextended way back then. There's nothing supporting these asset prices other than the Fed intervention. And if the Fed is intervening not to prop up the stock market and asset prices and real estate, but rather to rein in inflation and potentially curb unemployment, these folks are hopeless. And so the situation has not changed. There's no good news for Wall Street yet. Now, do I think that the Fed will pivot? Yes. Eventually the Fed will pivot. They've taught the markets that they always pivot, and the Fed does not like to do anything that the market doesn't expect. If the market has priced something in, as far as Fed actions are concerned, the Fed will usually take that action. And so Wall Street knows that they can bully Jerome Powell and the Federal Reserve into doing whatever they want. Now, Shadow Stats, their version of the unemployment rate went down too, but not down to 3.5%. It went down from 24.6% all the way to 24.4%. So don't have any illusions about this 50-year low unemployment rate. This clown Justin Wolfers, who's supposedly some economist who's never gotten a haircut in his life, looks like a total slob. He's out on Twitter getting, thousands and thousands of likes and retweets saying that, oh my gosh, the unemployment rate is at 3.5%. Clearly, this economy is still growing and thriving. And all of the people who thought that we were in a recession are conspiracy theorists. The only reason the unemployment rate went down is because labor force participation rate went down. And when you don't count people who are, quote unquote, not in the labor force as unemployed, yes, the unemployment rate can be quite low. Shadow Stats does count people who aren't, quote-unquote, in the labor force, and that's how they get to the number of, 24.4%. 1/4 of this country is not working. So we're not in good shape. The economy is not strong. The economy is not growing. This is not a dynamic economy. The U.S. economy barely has a pulse, and what little pulse the U.S. economy does have is going to get killed by these rate hikes. Because asset price depreciation, the reverse wealth effect, is going to have a disastrous impact on consumption, because all of a sudden people are going to look at their 401ks and say, you know what, I need to tighten my belt. I'm not going to go out to eat so much. Maybe I'm going to sell my third home and only have 2 homes. Maybe if they have 2 homes, they'll say, you know what, I might have to sell my second home, especially because prices are falling, housing prices are going down so much. I don't want to lose my equity. I want to sell it before I'm underwater. And these people who have second and third homes, if they sell their homes in these areas, they will no longer be traveling to those places and patronizing local businesses. There are lots of examples like this of how the reverse wealth effect will hurt our economy. I think of that example first because, I live in Florida and we have tourists and people who live here part-time in the year. And I think about those folks and how much they contribute to our local economy in terms of, they hire people to mow their grass, they hire people to paint their fence, they hire people to paint their house, they go out to restaurants every single night because they're retired and they don't want to cook. They hire plumbers to replumb their copper pipes with PVC ones because they're paranoid. They're from they're from up north, and they're told, oh my gosh, all these houses in Florida with the copper pipes, you get pinhole leaks, you have to repipe your whole house. And they go, oh, okay. All of this sort of stuff, when asset prices start to fall, it comes to a halt. It just does. And this will have ripple effects throughout the entire country. Not just where I live, not just where you live. We have been living high on the hog because of low rates brought to you by the Federal Reserve. Now, I'm not going to say that this was good for the economy, no, but it dulled the pain. It was, as Peter Schiff puts it, monetary heroin. And it did. The Fed was able to paper over a lot of our problems with QE and 0% interest rates. And so it's not like the Fed is really killing us by raising rates. They're just exposing all of the rot that they've papered over. And that's going to hit asset prices before it hits unemployment, which is why these folks on Wall Street who are waiting for the Fed to flip-flop, to save their asses, maybe in really bad shape. Because if the Fed really is focused on unemployment and not the stock market, which for the longest time they were very happy to focus on the price of stocks. They targeted stock market prices. That was my opinion. That was the opinion of many people. That seemed to be what they were targeting, not unemployment or inflation like they claimed. But maybe with the situation being as dire as it is, Powell has finally gotten serious about his job and has decided to really target unemployment and inflation. And so even if he flip-flops when when unemployment starts to get out of control, let's say when unemployment gets over 5%, Powell flip-flops, there's going to be a lot more damage done to the stock market before we start to see a lot of damage done to the labor market. So these folks on Wall Street who are waiting for the Fed to save them, I don't want to say this for a fact, but by the time that the Fed rides into the rescue, it likely will be too late for them. The margin calls will have already started, and things will be coming unglued. So, with that said, I will see you folks back here tomorrow.